All right, good morning, folks. So I'm going to speak today about the child tax credit and the differences between the 2021 and the 2020 child tax credit. So lots of changes. It's a pretty exciting time. They're making changes as we speak to the tax law. It is March. It is the craziest tax season we've encountered so far. So let's dive in real quick and I'll go over the differences, because if you have children under the age of 17 and under for 2021, it means a vast difference for your personal income taxes. So let's review the 2020 child tax credit, or what we call also the family tax credit. It was pretty straightforward. If you had children that were 16 and younger, you would receive a $2,000 partially refundable tax credit. So if you had earned income of at least $2,500, you could have stood to have received a $1,400 partially refunded tax credit. Tax credits can be either refundable or non-refundable, as you know. Refundable tax credits, if your taxes are below zero, if your tax liability ends up below zero, a refundable tax credit will refund you the money and you'll actually get a refund. And a non-refundable tax credit is just going to bring down your tax liability to zero, but not refund any excess. So that's the differences between refundable and non-refundable tax credits. So back in 2020, if you had a $2,000 tax credit for the child tax credit and it brought down your tax liability to zero, then if you qualified, you could have received a refund up to $1,400. So why is this important? Well, for 2021, you're actually getting a fully refundable tax credit. So they did away with this partially refundable tax credit business, and they're going to fully refund you if you have like zero tax liability. They also did away with the earned income rule. So that was a requirement. You had to have had at least $2,500 of earned income from a W-2 or business or something of that sort. And in 2021, there is no earned income rule. That's the big difference. What's important to understand is that the base credit has not changed. It's still a base credit of $2,000, and that is itemized over here. So there's a phase out. What is a phase out? The phase out is really when your income, modified adjusted gross income, what we call MAGI, once the MAGI reaches a certain amount for different filing statuses, you start to get a reduction of the credit. And the reduction is for every $1,000 your modified adjusted gross income increases, it starts to phase out. The credit phases out for each $1,000 at a $50 interval. All right, so for married jointly, that phase out would be at $400, and for all other filing statuses, it would have been at $200 modified adjusted gross income. That has not changed. So the base credit's not changed. But here's the major distinction. So let's go into the 2021. So 2021, it's no longer 16 and younger, it's 17 and younger, and it's a fully refundable tax credit. The new requirement, though, is that you have had to have lived in the U.S. for at least half of the year. And so that's basically what we call the principal place of abode test. All right, it's a little bit lenient. It's not a complete disallowance. If you aren't here and if the test is not met, you're still eligible for a partial refund. So it's pretty relaxed in that capacity. Now, the qualifications for the children hasn't changed. You still have to have a dependent child. That child has to be a citizen, national resident alien, have a social security number. You must be able to claim that child as a dependent on a 2021 tax return. That's the same rules as it always was. And must be related to you or basically live with you for at least half of the year. You still have to put that child's name, date of birth, and social on the return. So that none of that has changed. What's actually changed is the age requirements and this new principal place of abode. Now the credit itself has dramatically went up, and it's went up to $3,000 from $2,000 for children between the ages of 6 and 17, and up to $3,600 for children that are ages 5 and under. So that's a pretty sizable refundable tax credit, basically. And again, tax credits are dollar for dollar. They're not like deductions. Deductions save you taxes at a rate. So if you have a $3,000 tax deduction and you're in the 22% bracket, you're only saving 22% of $3,000, which is around 600 actual dollars. That's the difference between deductions and credits. So that's another important concept to understand. Now, there is a phase out again with this. Once you're reaching a certain amount of AGI, modified adjusted gross income, you do have a phase out that works a little bit differently. If we're married filing jointly or qualified widowers, you're looking at a phase out of $50. Again, that same $50 for each $1,000 of modified adjusted gross income. Once that amount, once your MAGI reaches 150,000 and starts to phase out, for head of households, it's 112.5, and for all other taxpayers, that's basically single or married filing separately, is 75,000. And so what does a phase out actually look like? So we have the chart here that will explain to you what that looks like. So here's that tax credit at 3,000 for, let's assume that this is 2021, you're single and the child is age 17. So age 17, remember, you're eligible for $3,000. So this access reflects the credit, and this access reflects your modified adjusted gross income. So as your adjusted gross income starts to increase, and remember, for a single or with a child age 17, you start to phase out at 75,000. So here it is starting to phase out basically. So your child tax credit is down to 2,000, and as your modified adjusted gross income starts to go up, it'll eventually get to zero as you've completely phased it out for every $1,000 interval. So that's basically what that phase out looks like. And again, you still have, but you're still getting that $2,000, right? So once you're breaking that 200,000 mark, you know, that's just this additional phase out only deals with amounts over 2,000. So between 3 and 2. That's when, you know, you're starting to phase out this amount. Once you pass that, all other filing statuses at 200, you start to phase out the 2,000 base amount. And here's that chart. So here's that 200,000. So you're at exactly 2,000 for this level of income, and boom, it'll drop to zero by the time you reach 250. So that's the child tax credit and the changes with it. So another important thing to understand is that there is, okay, let's go into qualifications. What do we talk about here? So what else is new is that they're actually going to advance you the child tax credit. That's mandatory, and you basically will receive 50% of the anticipated 2021 child tax credit periodic payments, and that's the start from July to December. So if you're anticipating a $3,000 tax credit from the children, they'll use your 2020 return or your 2019 return to estimate what your picture should look like for the 2021 and advance you 50% of that between July and December. So you're looking at, you know, $1,500 in 6 increments. So that's a little bit of what I personally feel that's an overkill, because it's going to create a lot of administrative issues for tax professionals and taxpayers, as well as the IRS and everybody involved, just to get that money going. I'm sure it's needed for some people, so it's a good administrative effort on behalf of Congress, but it will create a lot of nuances. So because what happens is, if you're overfunded, you'll have to actually return this additional overpayment to the government when you reconcile your 2021 tax filing. So they are required, the IRS is required by law to have a portal for taxpayers to be able to opt out of this advance, or to modify their information with the IRS and say, hey, this year I'm not going to have 3 kids, it's going to be 1. My status is changing. Because you can imagine this reconciliation becoming quite the nightmare for the 2021 tax filing season. So that's basically the gist of the reconciliation. So again, you can opt out. By law, the IRS has to create a portal. And any excess does have to be returned with your 2021 filing. The IRS will send out notices ahead of the advancement with instructions. And there is a safe harbor. So the safe harbor just basically is where you can opt out. Let me see if I have that. The safe harbor will basically help people that are overfunded, and they're basically going to make it a little bit less lenient as far as repayment. So you won't have to repay as much if your income is within certain amounts, and you have AGI that's, for example, single 40,000. So you don't have to worry too much of the overfunding, but still, it's a good idea to get all that straight before they start advancing you the money. And it's not always going to be visible what exactly your situation is going to be like in December compared to July. That's very common for it to change, for things to change as you're going throughout the year. So I'm curious to see how all this will play out at the end of the day. Quick example, so you basically have child tax credit. Chad is the head of household with a 2-year-old son as of 12/31/2020. Following AGI, 60,000 in 2020 and 62 in 2021. So his child tax credit is 2,000 for 2020. Obviously for 2021, as being head of household, he does not opt out. He's eligible for 3,600. Remember, for children under 5 years old, it's 3,600, not 3,000. So that's a sizable amount of a refundable tax credit. So what they'll do is they'll take basically 50% of that, which is 1,800, and fund you that between July and December of 2021. And that'll be a 300 per month check from the IRS. All right, if you have any questions or any follow-up on this, and any kind of feedback is also appreciated, please let us know. This is all dealing with the America to the Rescue Act Plan, American Rescue Act Plan of 2021. I hope that this is informative and useful to our viewers. And again, if you have any questions, you know where to find us, Freeman CPA, where your success is our success all day, every day. Thank you and have a great day.